So what I'd like to start out by saying is thank you very much for coming along and joining us tonight. It is the first time that we have hosted a webinar for our investors in the Aurora KiwiSaver Scheme. So we're really delighted to be able to come along and really share some information with you and also help you answer any questions that you may have about what's been happening in markets and what are the things that we may really be wanting to think about as we go forward. The way that we're going to run this thing, I'm just going to run through a few little housekeeping items. So a couple of things just to be aware of. Your attendance in the webinar isn't known to anyone else, so no one else can see you or will be able to see any questions that you might post up. As we're going through tonight, you might have some Q&As that you're thinking about. You can post them online. You'll see a little Q&A button at the bottom of your screen, and I'll be able to pick them up and I'll be looking for them as we work our way through tonight as well. One other thing that's just really important to know, this is not investment advice that we're delivering here tonight. We're just giving you information and helping you be more informed about the decisions that you're making with your investments going forward. So what we're going to do tonight is chunk it down a wee bit and do this in a few sections. So I'm really delighted to be able to say that we're joined tonight by Sean Hannigan, our CIO. So Sean has been with the company since it started and plays a critical role for us around how we invest your money and how we start to look at managing both the risks that come naturally with investing and also then how we also generate that investment performance, which is also super critical and important. Also joining me tonight is Marcus Wild. Marcus is a reasonably new addition into Aurora Capital. He's coming in as our Chief Client Officer. So he's really looking after everything that you see going on within your account, how we're communicating with you. He's working with our advisors as well to make sure they have the right information to share with you at the right time. For those of you who don't know me, again, I'm a reasonably new addition to the Aurora team as well, and I've come in to lead the business and really think about how we continue to deliver value to clients like yourself and how we can continue making things a little bit more easy for you to get around your KiwiSaver scheme and make sure it's doing the best thing that it can for you. So what we'll do as a start is I'll hand over to Sean. Sean's going to give us a bit of an update on markets. It has been, in my view, this is my words, a bit of a crazy time over the last 4 or 5 weeks, sorry. Craziness out of the US that's been driving some weird things around the world. But I think things have settled, at least for now, a wee bit, and we'll start to think about what that means over the next quarter or so. I know Sean's going, I'm not so sure.
Yeah.
Over to you.
Okay, yeah, thanks, Sharon, and welcome everyone. Thanks for joining us in your busy days. So look, I've been investing for close to 30 years, and this is probably the craziest time I've been through, and I've been through some pretty crazy times, believe me. But what's quite unique about this, it's really self-inflicted. It all comes down to the election in the US. So if we cast our memories back to October last year with the lead up to the election, looking like Trump was going to get elected, the markets got quite excited about that. They felt that there was going to be a lot of deregulation, freeing the sort of economy to get on and generate wealth, and also some tax cuts, which are going to be positive in terms of putting more money into people's pockets. Some of us were less sort of enamored by it, but nonetheless, the market took off and had a real rally. And those stocks that have been doing well for the last couple of years, namely most US stocks in particular, the Magnificent Seven, continued to rally pretty strongly. But then there was a bit of a rude awakening in February with the Chinese announcements of DeepSeek, which was a AI large language model that was produced at a fraction of the cost that some of these other models have been produced at. And suddenly the market started questioning the rationale of what these Magnificent Seven, a lot of these big companies are spending on AI, and whether it was actually justified. And so that just created a bit of a crack. And while this was all going on, the politics was happening. And then, the next big occasion was Liberation Day on April 4, where Trump came out and announced his tariffs. And certainly that caught the market completely unaware. The market was not expecting the level of tariffs that was rolled out. And even the way it was done was pretty bizarre, quite frankly. The rationale, how they applied the tariff formulas was pretty weird. and showed it wasn't a scientific approach. It was, there was rumours that it was actually done by ChatGPT. The fact that an island in the middle of the Atlantic that only had penguins on it incurred a 10% tariff made you wonder. And then following that, it set off a series of escalations, and it ended up with, the Americans putting 145% tariffs on Chinese products. And effectively what that does, it just stops all trade between America and the US. It's just not tenable that people can afford to pay those sorts of prices. And China retaliated, and this led to some real market falls, and mostly driven by the uncertainty. What markets don't like is uncertainty. If they know what's going to happen, they can prepare for it and price for it and manage it. And so what you found is that a lot of businesses just cut back on investment. Consumers stopped buying big products. People started worrying about losing jobs. And so we went through a period, which is still happening today, where what we call the sentiment indicators, which are the stuff like consumer confidence, business confidence, hiring expectations of businesses, and even inflation expectations all went really bad. So, confidence fell, inflation expectations shot up. But at the same time, the hard data was still coming in very strong. And so there was this battle between, was the sentiment, was the US economy going to survive this? Our view is I think what's been started is going to be really hard to slow down now. And I think we're going to I think there's a very high probability that US goes into recession. And if that does happen, a lot of the earnings expectations of these stocks are going to be pretty hammered. And so, I think the market is still battling. The market still wants to buy. And we've actually had quite a significant rally over the last 8 days, basically on the back that Trump wasn't saying anything, and so markets started to think, things are going to settle down. But then, of course, what happens is if the markets don't respond, Trump gets emboldened. He thinks the market's supportive of what he's doing. So that gives them, and he came out with this crazy announcement yesterday that he's going to slap 100% tariffs on all overseas films. And suddenly then it's the market's, he's at it again, and so it's so bizarre to be trying to manage money in an environment where markets have been dictated by the ego of a single person. And you can't try to rationalize it. You can think longer term, there's a strategic plan, bring manufacturing back to the States, but that transition is really, really difficult. And so how do we actually play the markets over that period? And so we've been quite concerned about valuations and concentration in the US market. So over the last sort of probably 6 months, we've started to ease back our exposure. And we'd moved to quite a reasonable underweight position in US markets and put it into other sectors that we just thought looked a bit more defensive, and some of those were areas like, global listed infrastructure, which we still like the sector because a lot of that sector is exposed to energy production. I think the world's still really short of energy. They're going to have to produce more power to decarbonize. And that got sold off in the back of Trump because clean energy was suddenly, it was going to be drill, baby, drill. And so that got sold off a bit. So we've hit a bit of their portfolio there, went a bit overweight. We've also been overweight a little bit in New Zealand equities. And that's partly as a function that New Zealand equities hadn't rallied as much. We don't quite know what's going to happen with the New Zealand economy in the back of tariffs. There's a school of thought that says, if global growth does really get hit, that will hurt the New Zealand economy because it's an open market. But there's also a view that, this Make America Great Again may actually make China and Europe great again, because what this is doing is forcing both the Chinese and the Europeans to tackle some of the challenges that they're refusing to tackle, mainly stimulating domestic consumption. So the Chinese are now really realizing they can't export to the world. They've got to get them consuming. For the economy to grow, they've got to get the local population consuming more. And that'll be great for balancing the world economy, right? And the same with the German economy, which was too much about exporting to the world, not about consuming themselves. So both of them are tackling that problem. And if that does happen, if the Chinese do cut consuming a lot more, that's going to be really good for the New Zealand economy. So there's a bit of we're not quite sure how it plays out in New Zealand, but it could be positive. And so we've gone a little bit overweight New Zealand equities, and that's actually done okay. The other area is just genuinely being overweight some of the unlisted stuff, our private credit exposure, which is exposure to New Zealand companies, and that's a pretty resilient sector. So that's continued to produce positive returns. And then finally, we've been overweight equities and bonds, both domestic and international, and cash. And so, this is a fact that we just think while this concern's going on, we'd rather be defensive. We might miss these bounces, but I think over taking a sort of a view of 18 months, which is the time horizon we try to make our investments, we think being out of the US market is probably a sound place to be, because I just don't think we're clear about the rules of engagement with the US. And while that happens, people are going to be taking their money out. And you've seen that because the US dollar is falling and bond yields in the US are rising, although they've come off a little bit recently with growth concerns. But basically, I think the world is now reassessing whether the US is a safe asset. And so if the US does go into recession, the deficit of the government there is going to increase substantially, and they're going to have to issue a lot more bonds. And if people are not wanting to lend to the US government, they have concerns about how they will be behaving, that means they're going to have to charge higher rates. And so that could be a bit damaging for the economy. So we prefer to hide in those other sectors, or hide's not the right word, but we just think this holds better value. And part of what we're trying to do with our portfolio is this smooth the journey, same destination. So try avoid the big drawdowns and don't mind if markets get frothy. We underperform a little bit, but over the long run, just get that smoother journey, which I think is a good way to manage money. So that's my 10-minute summary. Back to you, Sharon.
Well done. Thanks very much for that. And I think you've hit on a really, really important point. So what we're seeing at the moment is quite frothy markets. So things are a little bit more volatile than they have been for quite a long time. There is a fair amount of uncertainty, and that's really uncomfortable for investors. So what I might do is hand over to you, Marcus. One of the things that it'll be really interesting for you to share your views and thoughts on is when you're in these periods of volatility, it can be a little bit challenging to stay calm, particularly as an investor. You're seeing balances move around and go up and down. But if you think about the historical context of markets, and you start to think about that long-term trajectory of markets and not just those short-term fluctuations, things can look a little bit differently. So it's about keeping your emotions in check over that short time. So I just wonder if you can kind of share any thoughts and tactics that you've experienced, and also when you've been talking with advisors that they've been talking about with clients as well.
Yeah, thanks, Sharon. It's really interesting, isn't it, when we think about our human nature, and I'm always think about myself and how I react. And to be honest, I'm probably a terrible investor. I do all of the wrong things, even though advisors tell me otherwise. But we all have in our recent memory a market dip, and that was COVID. And pre-COVID, we often talked about this, kind of holding your nerve and thinking about the long term. But many of us had never really seen a market downturn. And along came COVID, and the behaviour we saw, anyone who was a KiwiSaver provider or in a KiwiSaver provider at the time, saw this massive, what we call switching behaviour. And what that means is simply everyone thinks that they're a growth investor until the markets go down. And the irony of that is that's exactly when you want to be a growth investor. So as the markets tipped off, we saw people losing their nerve, getting worried, reading headlines. And headlines in the news around markets are one of the worst enemies of the investor. Bloodbath. And now I've noted New Zealand media love to add KiwiSaver into the headlines, so KiwiSaver clobbered by markets. Now that is such a broad generalization. It totally depends on, for one, which fund you're in, secondly, who your provider is and what their exposure is. You just heard Sean talking about how he thinks about risk and managing risk for our clients. So the exposure for our clients may be totally different from another provider. The generalization does not help. So what does that really mean? It means you as a client need to think about your long-term objective. What were the things that you sat down and talked to your advisor? And that's a wonderful part of Aurora Capital. Everybody who's in Aurora Capital can talk to an advisor and has likely talked to an advisor and has a plan, and that's great. What is that plan? What were the things that made you choose to be in whatever fund type you're in? Have anything in your life, has it changed, or is it the same? And if the answers to that are no, it's the same, my goals are the same, then this is a fantastic opportunity. Now, things are tight. I don't expect people to suddenly pony up more money and put it into their KiwiSaver fund. I get it. But stay the course, keep contributing. Don't suddenly think that you're going to take a holiday and take that money and do something else with it, or that you might have a better option out there. Keep on contributing, because as markets come off, it's like you're buying shares on special, which I know is a really bad thing to say and a horrible way to say it. But it's like going, and we hear the analogy often, to the supermarket and baked beans are half price, and you were going to buy baked beans. You buy 2 cans and for the same money that you would have spent before on one. Well, guess what? When the markets bounce back, you have twice as many cans of beans. And Sean, if you haven't read it, go and have a look at the article. Sean tells a fantastic story about buying bricks, and it's exactly that. Buy more bricks. We're in the business of building a house for you at the end, not in manufacturing the bricks, right, Sean?
Yeah. Well, I mean, yeah, we're buying bricks. We're not selling houses yet. We're selling houses when we retire. So you're a 30-year-old, you're more concerned about the price of bricks than the price of houses.
Yeah, and look, I think there's a couple of good points that you picked up in there, Marcus, and Sean will get you to pick up on this point as well. So one of the things that we often find when these times do happen is investors can make those short-term decisions, and then they wonder about when they should actually reverse that. So they've come out of a growth fund, gone into conservative, and then they spend a lot of time thinking about, now that I've made the jump, when do I jump back? It's really important, I think, to know that volatility is always going to be one of those constants in investing. You can't avoid it, and you should kind of welcome it a little bit with open arms. What we do know, and it'll be interesting, Sean, for you to talk your way through this, is that the bounces that occur within markets, they tend to go back quite significantly, but generally over relatively short spaces of time. So missing those is one of the big challenges of trying to jump in and out of markets.
Yeah, look, I think it's, there's this thing called risk. And I think people sometimes forget about risk. They just focus on the return, and you get very good returns investing in a growth fund. But the consequence is that you're going to have some risk, and you need to be comfortable with that risk. And just the point about moving, if you have a big fall, decide, or you're concerned about the market, take it up from the conservative fund. The hardest thing to do is to make the call when you get back in. And so there's a great statistics that measured 20-year returns of the US equity market. And if you put $10,000 in 1998 and you remain fully invested in that market for 20 years, you'd end up with just under $30,000 after those 20 years. They're not putting any more money in, just that 10,000 compounded at that time. If you missed the best 10 days over that 20-year period, you end up with half the return, just under 15,000. If you miss the best 20 days, so it's 20 days out of 20 years, you end up with less than 10,000. So, the numbers are quite stark, and that's what often happens. You get these big falls, markets bounce back. And so don't try to time the market. It's what we do, the way we manage the portfolio. We will tilt, we may reduce our exposure by 1 or 2%, but we're always going to remain in the market. And it's sort of because you just can't time those things. It's just impossible. And especially in an environment like we're in today, anyone that tells you they know what's going to happen, run the other way. Because seriously, no one does. I think maybe Trump does, but I don't believe he knows what he's doing. People saying he's playing 3-dimensional chess. Actually, I've got to stop saying this. I'm probably going to be banned from going into the US if I keep talking like this. I'll ease up. But, it's really important to stay the course. And partly what we're doing with the way we manage our money is just try to smooth that volatility. So it's not an uncomfortable ride for you. So you can remain confident and remain invested in a growth fund, because quite frankly, as a 30-year-old, the most risk you can take is to go into a conservative fund, because you will end up with a very poor retirement.
Yeah, that's a really great call out. What I'll do is just a bit of a reminder, guys, you can post up any questions. So just at the bottom of your screen, you'll see a wee Q&A button. If you pop in any questions there, I'll be looking for them coming through, and we'll make sure that we weave them into some of the questions that we're asking of the guys. I think, Sean, you've touched on a really great point around the risk of being in the wrong fund. It's one thing that we just don't spend enough time thinking about. And when we talk about risk, we always focus about the loss, the potential that we're going to lose money, but we never think about it in the context that we don't have enough money when we get to the other end. So when we get to the end of either retirement or saving for a first home. So how would you help investors start to think about that, and our KiwiSaver members really start to think about turning the dial around on how they perceive risk?
Yeah, I mean that's a really tough question, Sharon. I'll have a go to the Marcus. Maybe you can sort of fill in the gaps.
It was a tough one.
Yeah, look, I think it's a really hard concept to understand, but the way I'd respond is, as a portfolio manager, I'm managing risk. I'm trying to take risks that I'm being rewarded for and avoiding risks that I'm not. But for most clients, it's the risk is, I think the bigger risk, quite frankly, is a poor retirement. And so you need to take advice, talk to your advisor, understand you've got a time horizon of 30 years. Short-term volatility doesn't matter. It's, don't look at your account every day. That requires a lot of maturity to cope with that sort of whipsaw. So it's believe in the journey, believe in what you're doing, and quite frankly, as important as the investment return is the amount that you contribute. And if you sort of up your contribution rate, you can, if the risk is great and making you uncomfortable, ease back the risk and contribute more. You end up at the same place with more control. And so I just think risk is a good thing because we get rewarded for risk. And it's just this market volatility is just a normally function market. And we've been through periods, world wars. Like for me, I've been through 5 quite serious financial events. Probably the most serious was the GFC in 2008, which I had a big head of hair back then, and I lost it all. But we survive. The markets, we always survive, and it's how these capital markets work. And as Marcus said earlier, like if you have big falls, if you're in your early 30s, that's a great thing. You're looking to buy a house. The best thing to happen for you is the house prices halve. And we just, so it's the way you see about the opportunity. But most important thing is stay the course. Understand your risk profile, engage with the advisor, and then just stay the course and just use your contributions to build up your wealth.
Yeah, and Sean, I think that's so true. And I often think back, we had a question come in, which I'm going to kind of weave an answer in for that individual in this. But when I remember, actually, and I'm going to reference COVID again because it's quite recent, going in, and at the time, the fund manager that I was working for, I had an investment team there on site, and I thought I was going to go in and see, I imagined what I'd seen in movies, right? They'll all be crying, the markets have fallen. I thought it was just, I've never seen a group of individuals more excited than when there's a massive market dip, because they're suddenly able to invest in companies that are now a good price, right? And things that they've been wanting to invest in for a long time, but were overvalued. And so you think about what you do, as you say, you think about your risk profile. And we had someone ask a question about, they're only 30 and should they be taking more risk? Well, one, look, talk to your advisor about that, because that's really a personal package. You need to think about a number of things. But I couldn't agree more with your point of make sure you're in the right fund, but then double down on how much you're putting in, because we and no fund manager can do absolutely anything for you if you don't invest money, because $0 with 1,000% return is still $0. And so your example of that long-term, the 20 years of the US market, from going from 10,000 to, I think you said, was it
20,000? Yeah.
30,000. Well, if the 10,000 along the way, you had doubled the amount you're contributing along the way, that would be just exponentially higher. So don't only focus on how aggressive you want to be with your investment, style or which fund you're in. Couple that with how aggressive do I want to be with how much money I'm putting into my investment, because that will have as much impact as anything really, Yep.
Yeah, fantastic. Thanks, guys. Sean, you've touched a lot on it, which I think has been super helpful, how you're starting to think about managing the portfolio, thinking about the exposure to the US and to Europe, and thinking about equities and bonds. What I think it'll be really interesting also to share a little bit of your insight into what you're doing within the portfolio, and starting to think about how you're using the managers that you appoint in or you bring in to give you different levers to also help manage that risk within portfolios, and also think about how you're positioning for that longer term as well.
Yeah. Okay. Thanks, Sharon. So we've just actually, timing's pretty good on that point, because we've just done a transition for our global equities where we historically had two managers, Dimensional, great manager, but they hold 3,500 stocks. So they hold most of the index, and they just tilt a little bit over and under. So they are always going to have a big exposure to the Magnificent Seven and the US market. And then Stewart Investors, which were a more diversified, less benchmark aware manager with a reasonable exposure to emerging markets. We've just replaced those two managers with three managers. In all cases, all three managers hold stocks at between 30 and 50, hold portfolios at between 30 and 50 stocks. So focus for companies they think are going to really benefit, less benchmark aware. So what that means in virtually all cases, they have a lot less US exposure. And that was important to us, because we think you've been through the last 20 years, it's all been about US exceptionalism. That's now arguably under risk, under threat. And as I said earlier, some of the steps being taken in both Europe and Asia are going to mean that these other economies are going to do better, arguably. So we wanted managers that weren't being forced to hold stocks in the US just because that's a big part of the index. But what also we did is we get some very different styles of managers. So we've appointed Brandywine, which is a value manager. So they tend to hold the cheap, like, what do you call them? The old-fashioned stocks, Coca-Cola, Caterpillar, these stocks that aren't growing at 40, 50, 60, 70% a year, but providing very certain earnings, irrespective of the economic environment. And so they're a defensive part of the portfolio. And so at the moment, we're overweight Brandywine because we just think there's a bit more concern about the market. So we want to be a bit more defensive in that asset class. We then have Pala, which is a core manager. So they'll move around depending on where they see opportunity, but they have a very large exposure to Europe. So they're about I think the benchmark weight to the US is about 63%. They're about 45%. So materially underweight, which is the position we want. And then we have Munro, and they're an out-and-out growth manager. So they tend to focus on parts of the economy that's going to benefit from climate change, but they have a very concentrated portfolio. And so what we can do within our global equity portfolio by having these three very different managers is adjust the risk profile of the fund based on the environment that we see. So we don't have to go under or overweight equities. We can just change the risk profile within this fund. So we've got more levers to manage that volatility. And that's really important. And the other point of this is that we're not reliant on the brains of a single person. We've got we've got hundreds of people that we can leverage off to produce these ideas into the portfolio. The other area that we're doing is just focusing on some what we call unlisted markets. The big challenge that we have in New Zealand, the New Zealand KiwiSaver market in the growth fund area is very different to the rest of the world, because our domestic capital market, New Zealand equities, is very concentrated. The largest stock in there is close to 16% Fisher & Paykel, which is so you end up put 20% into the New Zealand equity market. You have a very concentrated exposure to individual companies, which it makes me a little bit nervous. I don't like that. And so the average KiwiSaver has about 50% in global equities, which has been great for the last couple of years with the US and Mag 7 doing so well, but a bit risky going forward. But the challenge is you can't move more into New Zealand because you end up with too much stock concentration. So we've got to find other assets that we can invest in. And so a recent example is this private credit, and these are managers that lend to New Zealand businesses that the banks don't want to lend to. The banks have to hold too much capital to lend to these companies. They want to give you lend to mortgages. It's a lot more efficient for them to do that. And so these small businesses in New Zealand are starved of capital. So we're working with this manager to provide capital to these New Zealand companies. And you can get a return of between 8 and 10%. You're never going to get 20%, but you'll never get minus 5%. So again, it's just giving that stable return and finding an asset class that we can diversify away from global equities without getting too much concentration in New Zealand. So that's the big challenge for us at the moment, and that's the journey we're on, trying to find different assets to diversify away from this global equity exposure, which we have some concerns about given the big exposure to the US, but we can't put it all into New Zealand because of the concentration. But yeah, we're on that journey, and there are opportunities, and we've just got to be careful about it and make sure we can manage liquidity risk, etc. But we think there are some very considerable opportunities in the New Zealand market in that space.
It's awesome. I think there's a question that's come through, and I think it's a little one that you've sort of touched on, but I think we can dig into it a little bit more. And I'll actually get you both to give your views and comments on it. So Aurora Capital is relatively young and relatively new, but Sean, I know that when I came in and I talked to you about, so what are we doing and how are we doing and what makes us different? you were able to kind of share that experience and exposure, not just of you, but of the managers that you're appointing as well. So understanding that is, I think, really quite important, and understanding the IP and the IQ behind you and supporting you, and also giving you that roadmap to test out with them is hugely important. So it'd be interesting for you to touch on that a little bit. And then I think, Marcus, will hand over to you on how you see the difference as for Aurora versus some of those bigger providers in the New Zealand market.
Yeah, look, I mean, that's a fair comment. We've been around for 4.5 years, but quite frankly, I've been doing this for 30 odd years. And I had 12, 13 years with AMP Capital running their multi-asset business in Australia, which was like 120 billion of assets. So I've been around the traps. And so what we are, the way I describe us is we're a manager of managers. So we don't buy stocks and bonds. Our expertise, my expertise, is finding really smart managers to manage the money on behalf of our clients. And so across our portfolio, we've got now 10 managers, and they're each specialists. We have specialist global equity, special New Zealand equity, special global bonds, special New Zealand bonds, and cash. And so the skills that we're drawing is picking smart managers. It's finding smart people, having businesses that attract, motivate, and retain that talent. And so it's not a lot of risk. So, and then we leverage all these resources to bring to bear into your portfolio. So we talk to these managers every day. So I'm getting IP from all around the world, ideas. If we want a topic, like I was concerned about what's going to happen with US bonds, I send an email out to 6 of our managers, and I get all the IP coming back in. Stefan and I, who's the analyst working with me, we can distill that and get the ideas. So it's not reliant on me. If I got hit by a bus, the portfolio will continue to operate quite fine for the next sort of, 2 years if needed be. So I'm not making decisions on stocks and bonds. It's all about the managers. And once they're in place, our job is to make sure they're doing the job we want of them. So yeah, it's a young business, but the experience, if you looked at the track record of all the people involved, we'd have 1,000 investment professionals with average experience of sort of 15, 20 years. And so look, I've been doing this a very long time. I love it. I'm passionate about it. Gets me up every day, and it's sort of so yeah, I hear the question, but it's like I'm driving a new bus, but I'm an old bus driver.
It's good. I like that, Sean. Look, I what Sean just talked about there, Sharon, I think is one of the real key points of difference for Aurora, and the way I summarise it is that we have a multi-manager approach, and the thing to think about is these managers all have different styles. And when we think of the KiwiSaver market providers in New Zealand, many of them, and certainly, and I'm not going to name them, but some of the ones that I'm sure will leap to people's minds are single style. And so you are putting your eggs in that basket, that style basket. And sometimes it's going to do really, really well. The market's going to favour that style, and it's going to perform above the market. And then other times it's not going to. Now, again, when we go back to that whole trying to pick market cycles, are you going to try and also pick which style? I mean, I have tried desperately to understand some of the nuances of these styles, and I quiz Sean from time to time on some of these styles. But the reality is, I don't need to know. What I do need to know is that with a blend of these different managers and styles, that will smooth that journey out for me. And so what that means to me is I won't have as wild ride, and I'm less likely to make terrible decisions like we were talking about earlier, changing perhaps into a conservative fund from a growth fund during a market dip and vice versa. And I think that leads me to another point, which is if you are an Aurora Capital client, and at the end of the day, if you're on this call, then you are, then you have an advisor. And that I truly believe in. I think that having advice, understanding KiwiSaver as a product, how to maximize it, and almost having that co-pilot or coach in the background, and perhaps you in your advice discussion said, yeah, you know what, next year when I get a pay rise, I probably take a little bit for me, but I'm going to up my contributions to 4% because I know that's better for me in the long run. They'll remind you, and kind of kick you in the pants a bit and say, hey, now's the time to do that. And I think that ultimately will make a really big difference. The other thing to bear in mind, and I'm personally a very proud Kiwi, and I think that it's important that we are a Kiwi company. We're owned and operated here in New Zealand, and when I look around at the KiwiSaver providers, particularly the bigger ones, there's a lot of money that flows offshore there, and I don't think it's necessary. I think having Kiwi ownership actually means something. I'm just old enough to remember that when we used to put the Kiwi Made emblem on products, and we'll proudly buy it. So I think those are really important points of difference, and ultimately add up to a whole picture of why Aurora is a little bit different from others in the market. I'm not saying from any stretch of imagination, I'm really proud of KiwiSaver as a brand and as a product, and I'm really proud to be part of it. I think that everyone does a great job, and we all have the best interests of clients at heart, but that's how we're a bit different.
Yeah. Well said.
Fantastic. That's been really well said. I think one of the other points I'd just add into that, the reflection on working with an advisor. There's quite a bit of research that's come out within New Zealand over the last couple of years that points to members that are working with an advisor generally end up about 4% better off in terms of their return. And that goes to they're putting in a bit more money, but they're also not making some of those shorter decisions around that market volatility. And that links back again to Sean's point. When you miss out those key dates in any period, you really can impact that long-term trajectory of your retirement savings. One last thing I'll just finish off with is just that little bit of a plug, which we should always do at this time of the year. Government contributions are coming up on us hard and fast. If you can, make sure you maximise those. It's the only time someone's going to give you basically a 50% return on your investment. And it is guaranteed. There are no other guarantees within investments that look quite like that. So if you can, make sure you get in there and do that just before the end of June this year. It is really important to make sure that you are keeping up to date with your investment, making sure that you're talking to your advisor at least once a year, checking in and making sure that you're on the right track. I think we're pretty much now coming to the end of our webinar. I really do hope you found some value in this. We've really loved it being able to host you for tonight. What we would ask, if you've got any further questions, just pop them through on an email. We'd love to hear from you. And we're also keen to know if you would like to have further webinars and if the time works for you. It could be that you'd rather it was earlier in the day. It could be that you'd rather it was on a different day of the week, but definitely would love to hear any of the feedback that you might have. So I think what we'll do is call it there. There will be a video of the webinar that goes out to all clients a bit later. So don't worry if you've missed something, there'll be an opportunity to rehear it. Once again, everyone, thanks so much for your time tonight, and we look forward to talking with you again soon. Okay. Cheers, everyone. Bye-bye.
Thank you.
Thank you.